Good morning everyone and welcome back to Morning Markets here at True Potential. Today we're going to discuss the US jobs data for the month of July and the likely consequences for trend inflation. So it was the first Friday of the month and of course we get the US jobs data for July. Now there is clear evidence of a slowing in the trend of job creation across the US. This time last year the number was above 400,000. And the trend from the most recent data is that we're somewhere around about 200,000 jobs per month. And in fact, the last two prints have been slightly below that. But the 3-month average is certainly in a trend of around 200,000. Now, this is probably too much to bring down inflation pressures. The Fed would like to see unemployment actually rise towards 4%, but the most recent number showed a further decline towards 3.5%. So we still have a very healthy jobs economy in the US, and it's services which are leading that strength, with the majority of jobs created this time in the healthcare sector. So unlike this time last year where it was retail focused in jobs creation, leisure, hospitality, this time it was healthcare. We're also seeing some notable strength in the goods producing industries, which is very pleasing, although the gains here were entirely in the construction sector. And there are two interesting conclusions to draw from this. The first is that the Biden CHIPS Act is actually a very strong tailwind for the manufacturing sector. Recall that this act is giving subsidies to US businesses who are willing to reshore manufacturing capabilities onto US soil for the production of semiconductors. And this is a very strong tailwind for the construction sector as that manufacturing capability is built out. The second conclusion we would make is that the manufacturing sector as a whole is likely softening. Not anywhere near as bad as, say, China or Europe, which are in deep recessions within manufacturing, but there are certainly headwinds coming from the global impulse. But the Biden CHIPS Act is definitely providing some tailwinds for the construction side. Now, what about the wage number? Well, we saw another uptick, and in fact, the 3-month momentum of US wages is pointing to a number which is around about 4.9%. So this is much too strong to be consistent with a 2% inflation target. But this actually isn't the Fed's preferred measure of wage growth. They prefer the employment cost index, which was published the month before. And that actually showed a slowing. This preferred measure adjusts for the composition in different sectors within the economy. And this number is actually closer to 4 and slowed materially through Q1 into Q2. So there is much to be optimistic about for the Fed on the inflation side. We're seeing a slowing in jobs creation. We're seeing a notable slowing in wage growth. But underlying economic growth remains quite strong. Plenty to be optimistic about, but please do join us again tomorrow where we'll update you on data within Europe and the UK. Thank you.